everybody? Good morning and welcome back to Beat the Bell presented by Kane Capital. Hope you guys all had an awesome weekend. So last week was FOMC week and we were greeted with some pleasant volatility in the markets, rallies, sell-offs, especially that Thursday into Friday trap that we saw. Very interesting price action. Now, moving into August, we are opening a brand new trading month. What can we expect? To talk about it, we've got Money Mander with us this morning. Mander, good morning.
Good morning. Happy Monday. Pleasant is not the word I would have used to describe the volatility, but on to another week.
All right. Diamond Trades, good morning to you.
Alejandro, what's going on? Last week, obviously pretty volatile. The market's heading into August. A lot to cover, a lot of wrap up July, and we'll talk about it in a little bit on Fed Forecast.
Is that a little mustache you got going?
Yeah, so I went to the beach this weekend, and I truly wanted to be in my like Zac Efron Baywatch sort of phase, and so
yeah, you look a lot like him.
There. That's what I thought too. That's what I was going for.
All right, good stuff. Fed Forecast, economic calendar. Let's do it.
Yeah, let's start with the economic calendar for today and this week. So we've got Chicago PMI and Dallas Manufacturing Index today after the open, followed by the S&P Global PMI tomorrow, and the JOLTS job openings tomorrow probably be the biggest news before Friday. Wednesday, we've got ADP employment change, really not much there. Thursday, the weekly jobless claims and the ISM services PMI at 10. And then Friday, we'll wrap it up with NFP and unemployment rate. That'll definitely be the highlight of the week as far as news goes. And that's before next week, where we will get some more inflation data for the month of July, which is coming to an end today. So this is the last trading day in July before we head into August tomorrow. Let's go ahead and cover the earnings calendar as well. We've got a lot of earnings coming up this week. And so notably, we have Apple and Amazon reporting on Thursday. Those are going to be the most anticipated numbers for this week, and we'll pretty much wrap up the large cap tech earnings, even though we'll have some more trickling in. The mega caps will more or less be finished after that. Some other notable names: Tuesday pre-market, Uber, Pfizer, and Merck. Tuesday after the close, AMD and Starbucks. Wednesday, we've got CVS pre-market, and then PayPal Shop, Qualcomm, and a Buffett favorite Oxy after the close. And then Thursday, we have Anheuser-Busch. We get to take a deeper look at that Bud Light. What's the word? Boycott, right? So I think that'll be interesting. See exactly how much damage is going on there with the boycott going on. Let's go ahead and take just a 10,000 foot view, given that we're heading into the end of the month and we've gotten a flurry of data over the past several weeks. It's probably a good time to take a bit of a step back and contextualize where we are. So as we head into August this week, inflation has come down significantly off the highs of last year. Core PCE, the Fed's preferred measure of inflation, printed 3% on Friday, down from about 7% a year ago. So I'm attribute this directly to the Fed's aggressive interest rate hiking campaign, with the most recent 25 basis point hike that we got on Wednesday, bringing the target range for the federal funds rate to 5.25 to 5.5 basis points. That's the highest level in 22 years. Others believe that the market decline in inflation is a bit more likely due to supply chain pressures easing. The supply chain pressures that we've really ran into in 2020 and 2021 after the entire world was shut down there for several months due to COVID. We started it back up, and that really did lead to some supply side issues that really put upward pressure on prices, as well as obviously what was going on with the stimulus. You couple that together and you get aggressive inflation, right? The Fed usually raises rates to make the cost of money higher, in turn lowering demands for goods and services from a consumer standpoint, and lowering the demand for investment and labor from a business standpoint. All in all, increasing unemployment and putting downward pressure on prices, right? That's sort of the Fed's goal when they engage in this aggressive monetary policy, really dampen demand and allow that supply allow the supply side of the economy to come back into balance, and that should really help with the inflationary pressures. That's really what they're shooting for. This year, however, while price growth has certainly slowed, like we just talked about, we haven't really seen that lack of demand for labor, right, as evidenced by the 3.6% unemployment rate, which is more or less flat from like a year ago, right? So even though the Fed has been raising aggressively throughout this entire time, that's why some people are a bit, I guess, confused as to whether or not, the price reductions, and really wouldn't even call them price reductions, but the slowdown in price increases that we've seen over the last year, whether that's directly due to the Fed or whether that's due to some extraneous outside factors, including easing of supply chain problems. According to the journal report published by German Insurer Alliance, identified 3 different forces on the U.S. inflation rate since the second quarter of 2022. Higher inflationary pressures from consumption growth, strong labor markets, and government spending added about 4 percentage points to inflation. Fading supply chain disruptors subtracted about 5%, and the Federal Reserve's action subtracted another 5 for a net impact of inflation that has fallen down 6 percentage points from a year ago. Whereas this inflation would have only fallen 1 point without the Fed's direct actions, right? So that's both through their use of monetary policy by raising rates, and also through their forward guidance and sort of their anchoring of inflation expectations, right? We heard Powell all last year basically telegraphing exactly what their plan was going into the next 12 months and what they were sort of seeing on the inflation front. And you saw that sort of ripple throughout the economy, with bank CEOs saying all throughout last year how they were preparing for what could potentially be a really nasty recession and really shoring up their balance sheets. And so even them just saying that, we're sort of expecting inflation to really be sticky here throughout the next couple of years, and we're going to keep rates elevated for the next couple of years, that alone can influence other people's behavior. So not only the Fed's actual actions of raising interest rates and shrinking the balance sheet, although albeit slightly, a bit less than they had anticipated, but from the start of the year, all in all, their actions together have definitely made an impact, to the tune of about 5 percentage points to the downside on inflation. So it suggests while the Fed certainly has had a material impact on the rate, on the rate of price increases over the last year, we should be paying attention to other factors, namely supply chain issues, which appeared really to be improving day after day, for clues on where inflation and thus interest rates are likely to head in the near future. Sal, what do you got?
One of the earnings I wanted to mention that we didn't cover on the earnings calendar is Coinbase. I think this is another one poised for a really big move, because as you come into earnings, especially after a big move like we've seen, the stock's up 100% since the start of June. Obviously, when these stocks are hot when they come into earnings, if they have a double beat and guide well, the stock's already hot. And so you see massive moves to the upside. But at the same time, if they go ahead and miss after the stock's rallied 100%, then you see massive exit liquidity coming up. So I don't really know where the IV is on these premiums, but I'd expect to be pricing in a pretty big move. Right now it's trading 20% off of highs, but still up 100% from the start of June. So that'll be a big one on Thursday as well. The one thing I wanted to cover today, bring some macro back to the segment, is the equity risk premium right now in the stock market has fallen to 20-year lows. And so kind of as you mentioned, as we've seen this massive rally going back to October, off of the forward-looking optimism on inflation, the Fed's still been raising rates this entire time, really even just going back to last week. And it's brought this equity risk premium down to 2-decade lows. So this premium is kind of seen as the percentage ratio investors are paying into and supposed to be rewarded with for taking that risk in the markets versus, say, like a risk-free bond benchmark. And it's calculated with a 12-month forward EPS of the S&P 500 compared to a 10-year treasury. So right now, with just a standard 10-year treasury, it's sitting at 1.1%. And then even using a TIPS, which is inflation-protected treasuries, sitting right here at 3.5%. So moving forward, I think kind of similar to that NASDAQ and Russell 2000 ratio we showed before, this isn't necessarily that one thing has to happen or that stocks are overvalued here versus a treasury based. I think that's really just the surface level analysis of this. But 2 ways we could see this unwind, because obviously historically this will unwind. We're at 2-decade lows here going back to 2003. The 2 ways I could see this unwinding is really right now, the Fed's at their terminal rate for the federal funds, most likely sitting here at 525 to 550 basis points. So right now into the end of the year, we have a 63% probability that we don't see another hike going into the end of the year, into that December meeting, the far favorite. So most likely rates are at top right now. And then even going into next March's meeting, we have a 37% chance being the favorite of a cut at next March's meeting. So likely pause here into March. At least this is what markets are pricing in. And then we start to see a QE cutting, unraveling of this hiking cycle that we saw starting in next March's meeting. And so obviously when you get this plateau in yields, prices begin to go up in bonds as you start to see the unwinding and the cuts with their inverse relationship. you can think of it fundamentally, right? If we're at the top of this rate hike cycle right now, and yields are likely not going to be this high for the next years to come, investors are then now more optimistic and want to buy into these bonds that are not going to see these levels for probably the next 5 to 10 years. So that's how you can think about it. Once they begin to start lowering yields, the price of bonds starts to go up and they start to trade at a premium again versus the discount we've been seeing. Obviously, if yields begin to fall, that is then going to increase this ratio. The second thing being, if we have increasing margins on the profitability and the EPSs of these companies. So if companies continue to guide higher, which would raise that forward-looking 12-month EPS, assuming at the same stock price, right? If companies begin to be more profitable and increase margins, that would then also increase this ratio with the EPS being at the top side of the ratio. So we'll see how this goes moving forward. Obviously, I think going back, we've seen historically that really the decline that we've seen in the stock market usually comes after rates begin to get cut. But then at the same time, that's because we've never seen a successful soft landing like so far we are seeing. And usually the Fed has to pivot out after some black swan event or a massive crash after they begin their hiking cycle. So we're kind of in unprecedented waters here. The one thing I want to note here, Chief Economist Brian Jacobson has said before, I haven't found a very strong statistical relationship between an earnings yield relative to the 10-year treasury, whether real or nominal, on a 1 to 3 year horizon. These future returns typically are not represented well in this statistic. But I did just want to bring it up that after this massive rally we've seen off of October, it really has not coupled with either yields or a forward-looking EPS. It's really just been on a lot of optimism that if we do get the soft landing, then earnings are going to begin to increase moving forward. But we've seen this rally so extended to the upside. While yields are still increasing, you are getting paid really the least premium you've seen for taking risk on in the market in the past 20 years.
I will say, we're seeing a few sort of metrics like that, right? I think for the VIX, it was like the price of buying protection against a 3% or greater downside move on the S&P in the next 30 days. It's more or less what the VIX measures. The cost of doing that, the cost of buying that protection is at its lowest level, I think, literally ever. Mm-hmm. So that's one thing. I mean, you're stacking up all of these like unprecedented sort of market events, and it's definitely interesting. I will say we had Markets Mayhem on the podcast last week, and we were just released it yesterday. One of the things that he talked about was that, you know, a lot of what you were discussing in terms of having these companies sort of grow into these valuations that they've achieved, you know, since this rally off the lows. You're having ridiculous forward-looking EPSs and X, Y, and Z, and a lot of that is because of AI. And people are talking about AI is really going to be a sort of a paradigm shift in productivity, and that's, you know, where the earnings growth will come from. And it's definitely going to be interesting as we look not just at the earnings reports that we get for the remainder of this earnings season, but like you said, the guidance into the next quarters, and see exactly what sort of material impact AI is expected to have on the top and bottom lines of these companies, particularly the bottom lines. If you're thinking about, you know, using it to become more streamlined and more efficient, that would really be more of like a margins thing. So I'm also, you know, I'm in the same camp as you. I think that it's definitely, we're going to have to see these companies grow into these valuations. Even Microsoft said they don't really expect their AI improvements to really have much of a material impact on revenues until, you know, the second half of 2024 into 2025. So, I mean, these things are not something that's going to happen overnight, right? It's not like AI is going to transform a company's margins. AI is going to, you know, drastically increase revenues or drastically cut your costs, you know, overnight. It seems like it's going to be sort of a long-term thing. And I think, you know, we'll have to see if these companies can grow into these valuations over the long term. But that'll wrap it up for us here at Fed Forecast. Pass it back to Alejandro.
Awesome, guys. Thank you. All right, so we're going to quickly take a look at the S&P. So over the past week or so, if you guys recall, I've been talking about how when you get a giant leg like we did at the beginning of July when we got the breakout over the previous July highs on July 12th, we got a 150-point rally, right? And typically what happens after that is the market needs to digest the move. And that is either done via a corrective move that is a strong pullback, or simply sideways action that's just kind of designed to trap both bulls and bears. So that is exactly what we have gotten. So we got really nice trend to start July, right? We got this giant rally. All you had to do was buy and hold Then when we're taking a look at the system, towards the end of the month, we can see how we have sell signal, buy signal, sell signal, buy signal. And it was really just a choppier range, which is why after you get a giant leg up like that or giant leg down, giant pullback, it's super important to be able to kind of step off the gas, realize that, that home run mentality is only going to get you in trouble. Now, buying dips at the 1 hour 50 SMA was a winning trade several times. We did get this one fake down below, but the best way to trade this type of environment versus that buy and hold where you can hit those home run trades, because you never know when those home run trades are going to come. You don't know when the market is going to trend, right? It's safer just to have a standard procedure for locking in profits. So whether that's taking most of your profits at the first level of resistance, your second level of resistance, whatever it is, I think that it's important, especially in a choppy environment, to book those profits when they're available. So hopefully you guys were able to manage well through the end of the month. But as we can see here, this was much more difficult trading conditions than it was for that, 2-week period where we were just trading higher in July. So now coming into today, the market is green here in the pre-market. So same thing as always, guys, going to be watching for the 50 SMA on both the charts to serve as support, but keeping in mind, again, that things have been choppy. And we're going to talk about that a little bit more in just a few minutes. I'm going to cover bet the bell for us today, excuse me. So we'll get right into that. Starting with the first question, green or red? Diamond.
Sorry, I muted. I'm going to go with green for today, and I'm going to go with red for the month. Slightly monthly.
We haven't gotten to that. That's question 2.
Oh, my bad. I thought it was part of the same question. I thought it was part of the same question. My bad.
Well, yeah, no, it pretty much is, but we'll one at a time. So green today. Already said red for the month, but we'll talk more about that in a sec. Money Mander, what do you got?
Getting too excited over there. I'm also going to take green as well. Futures up a little bit in the pre-market, and QQQ has a really nice cup and handle forming on the daily. So I think if anything, maybe take those recent highs and then see where we go.
All right, I'm going to go green for today as well. So Diamond did jump the gun a little bit, but the second question is green or red for the month of August. Now, first, let's take a look at seasonality so we can get the bigger picture here of what has happened over the past 20 years or so. So here's the seasonality chart. As you guys can see, typically the market gets some corrective action starting on the 1st of August. And Ryan, if you want to put up the next screenshot, please. All right. And on average, over the past 20 years, August has returned 0.1% and has been green about 60% of the time. Relative to July, that had an average return of 2.2%. And right about now, we're up about 2.5% on the month. And July, on average, over the past 20 years, is green 75% of the month. So coming into July, we were all pretty bullish. And as things were starting to break out, seasonality was tracking perfectly. And we were all kind of saying, hey, I think that July can be a ripper of a month. And that was exactly what happened. But now coming into August, things are a little bit trickier to gauge based on seasonality and based on the fact that we've already had these massive rallies. So into question 2 now, August, green or red? What do you guys think? Starting with Diamond.
I'm going to go red. I think that we can get like a slight pullback into September. This is like a bit more of like wishful thinking. Like if August is going to be choppy like it is historically, at least like give it a pullback so that we have some like nice upside range into September. That's what I'm hoping for anyways. Like I'm not talking like 10% like corrective move. I'm talking like 5% pullback max, slight pullback, set us up for a nice springboard into the second half of the year.
I'm going to speak the same into existence. I'm going to speak the exact same into existence because I would like to see this happen. I'd rather see a pullback than chop. I think last week was like my least favorite type of price action where you're just trading in range. And looking at Rocket Scooter, we are seeing a lot of bearish positions start to get put into August. We're seeing those bull zones go higher along with the bear zones. So I think it's likely we do see some type of pullback, at least in the first half of August here.
I'm completely in agreement. So I'm going to go with green for the month, just because we're in a very strong bull market right now. And again, August 60% of the time has been green over the past 20 years. So it's not like, this is seasonally a necessarily bearish month. But we do see this kind of cool off action into this part of the summer. I do think that we're going to trade green, but I think that it's going to be much more tactical. I mean, basically, chasers were getting rewarded during the month of July. Everything was breaking out. You could position yourself before the breakout. Even people who were late to the move are able to just buy. So I think that the trading in general is going to be a bit trickier moving into August. I think that we'll get some sideways action. And honestly, if we do get a red month, as Diamond mentioned, if we get a pullback to some major supports, that would be awesome to set us up for the coming months, and also to buy some of our favorite stocks, because everything just kind of seems to be ripping face and giving us zero opportunity to buy more. So that's going to do it for that question. Number 3 now. All right. So this is a conversation I've been having with my buddies as of late. And Ryan, if you don't mind putting up the tweet. So Unusual Whales on the 29th of July tweeted, in 1981, the cost of a single family home was $66,000. The average home price currently in America is $410,000. So this is very interesting for our generation. The three of us are 24 years old. In 1981, that was around the time that our parents were either beginning to look to buy a house, or they bought a house around that time. So it's very, very interesting to look at these prices. Obviously, inflation takes a big role in this. But I'm curious as to what your guys' thoughts are, and how expensive it is to buy a house. Me personally, I don't know anybody that has bought a house, that has a mortgage. Everybody rents our age, and the thought of even buying a house is pretty intimidating for us. So what are your guys' thoughts in general? Do you feel that we're being outpriced?
Yeah. You want me to start? I'll start.
Sure.
Yeah. So if you look at the inflation rate from 1980, that's where the graphic was from. If you want to throw the graphic back up, Ryan, if you look at the inflation rate from 1980 to today, it's about on average 3.09% per year. And so that same 66,125, if it tracked inflation perfectly today, would be about 244,000. And as you can see, the average home price is 410,000. So the price of homes has outpaced inflation significantly, whereas on the other end of the spectrum, wages have not done the same thing. On a real basis, wages are more or less flat from the 1980s, which is a pretty wild stat. Like if you remove inflation from the equation, wage growth really hasn't been there, for the hourly worker. And so it begs the question, like you said, how can there be such a crazy price increase in homes when people aren't getting paid significantly more? And I think that, if you're a bit older, you probably have the benefit of your retirement accounts. If you've been in the market at all over the past 20 years, you're likely doing pretty well from that standpoint. And, we obviously, a big part of that is time, right? Just constantly putting money away and constantly putting it into the market. And if you're young, below 30, you haven't really had that time factor been able to kick in for you, right? And really benefit you in terms of, your net worth as an individual. And that obviously is going to play into your security in terms of buying a home, right? Like you said, it feels like a daunting task. And I think that's definitely part of it. And then secondly, competition, right? We live in the Northeast. Alejandro lives in New York. I live right outside of New York. Like, these are highly desirable places. And we're not just competing with people from our area. We're competing with people from all around the world who want to live, in some of the greatest cities and some of the greatest, parts of our world. And I think that is another factor, right? There's always going to be a demand to live in New York. We've seen that throughout COVID, where, New York real estate is dead. New York real estate is dead. That's all you heard. And, apartments are still selling for record highs, right? And that sort of that sort of thing is because you're not just facing competition from people who live in America. You're facing competition from everybody everywhere. And, this is a highly desirable place to live. And so that constant pressure of demand is always going to be there. And so I think that also sort of factors into that equation as, the world becomes more and more connected, and it's easier for somebody to just pick up and move into New York, per se, than maybe 4 years ago. And I think that just constantly gets easier. And so you're going to constantly have that competition from people who don't necessarily live inside of America. And so for a bunch of different factors, I think it's definitely a much different situation today, for younger people. And, I wish I had the solution to that, but I really don't. I think, like you said, in the short term, it looks like renting and just sort of stacking your bread and saving your money as much as possible. And that's sort of where we're at. There you go. Home price to median household income ratio has just absolutely skyrocketed. Particularly since that bottoming out in the 70s. And this is not just a United States phenomenon either. I believe that you can see the exact same thing in England and other parts of Europe. So it's definitely a phenomenon that for people our age, it seems like we're getting the short end of the stick. But what are you gonna do?
I'll throw in, so compared to the housing bubble, we obviously are still, even on recent metrics, very, very expensive to own right now. It's actually cheaper to rent than to own a home right now with where rates are at. But going back to that 1980s, we are unfortunately in a new paradigm where we're never going to have that opportunity our parents had, because as the United States went culturally towards dual income households, you now have double the income in a household. That's really what drove that massive inflation from the 80s. When you think back to like the 50s, the 60s, the 70s, it was way more common for there to be stay-at-home moms and just a working dad or a business owner in the dad, or vice versa. But now it's really the vast majority, I would say an 80+ percentile of dual income households. And so now when you're doubling the household income, obviously that's going to drive, you're able to then sell houses for more. And that's what really drove that. So for guys like me and Diamond here, that leaves us kind of on the short end of the stick here, one on age, but two as still looking for our ladies out there. So we're gonna have to see. It's tough right now, right? 7%. I think if anything, we're finally starting to see home prices come down, as shown by Case-Shiller. They are starting to turn negative on a year-over-year basis, but still just so elevated that it makes it really tough, especially with 7% mortgages right now.
Alejandro, let me ask you a question. Would you want to buy a house right now? Like, even if you could, like, is that something that you would like heavily consider? Because like it's a little bit different for us. Because like even if I could, I don't know if I would really want to.
Yeah, no, that's a really good point. And the reason I started thinking about this stuff is because we look at I look at what we do, and we can work from wherever we want to work, right? After COVID, a lot of our our friends started working remote or hybrid, and so there's kind of this idea of everybody can move around to wherever they want to be, and we don't really have that. When I think about my parents, they were born in Florida, they went to school in Florida, and they bought a home in Florida, right? There was no like for me, it was like, all right, I was in Florida, and then I went to Penn State, and now I'm in New York, and then what state am I going to go to next, right? Times in general are very, very different. You made a good point. I'm not even, interested in buying a house, but I also, at the same time, looking at my bank account, understand how much, renting hurts me versus if I had the opportunity to buy a house and settle down somewhere, would that be something that I would be considering within the next few years? But I don't even see that as being a possibility, right? So it's just very, it's very different times in general.
I think in regards to the bank account, it's equally as expensive to buy a house, but at least you're building equity and owning it versus in rent.
Exactly. Yeah, exactly. Right. And Noah made another important point. He said, time hasn't really been on our side. It really does seem like the environment now is that you have to have passive income coming in, whether you own real estate, whether it's through stocks, right? The salary alone, you talked about the gap in the salary and the medium income. The salary alone isn't going to get you over that hump, right? It's like we're kind of working against the current. And so having that passive income is the best way to close that gap. All right, guys. Any other points either you have? Are we good to go?
No, that was a good one.
All right, sweet. So it is 9:04, right on time. That's going to do it for Beat the bell this morning, guys. Appreciate everybody who tuned in. We'll be trading live all day in the Kane Capital Discord. You guys can go to kane-capital.com or scan the QR on the screen right now. Again, we'll be trading live all day. Appreciate you guys for joining us this morning. Have a great day. Have a great week, everybody. We'll see you back here on Wednesday morning at 8:30 a.m. Eastern Time.